Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. We got so much to talk about with James Bullard, of course. Original is St. Louis Fed, with all the research heritage of the St. Louis Fed. His PhD from Indiana University, and he's wearing a boiler-up Purdue pin today.
I know.
With this wonderful new challenge he's taken on. What's the difference between IU and Purdue?
Purdue is number 4 engineering school in the country, so it's MIT, Stanford, Berkeley.
Out in the Midwest.
Purdue, so the medical school is down at IU, but engineering is at Purdue. So it's a great technical university, and the business school is aiming to combine even better than we have with the engineering school and get great graduates.
You're enjoying the private life.
Oh, I am, and it's going very well. It's great to be back on campus and around the students and hanging out.
I want to go back to, I believe it was 2016, and Dr. Bullard, you had a profoundly important paper saying, as Lagarde is saying at the ECB, we got to get off this idiot media micro-analysis of data and look at the regimes that we live in. As we go to this Fed meeting today within disinflation, with the Fed, with the ECB leading with the rate cut, for Jim Bullard, is there a new regime out there right now, post-pandemic?
I do think we've switched regimes. We're in a higher nominal interest rate, higher inflation environment, and I think that means that comparisons should be made more to the second half of the 1990s and the first part of the 2000s than to the 2009 to 2019 period, which was a low nominal interest rate, low inflation regime.
Paul wants to get in here. We're going to tie the bow here, if I can. It's critical. Is this the press conference where we get some form of hint or statement to where Bullard and Krannert are, which is away from the slavery of 2.0%? Do we get a higher, an understanding of a higher run rate for R-star or for inflation?
Inflation, no, the inflation target will stay at 2%, but inflation itself, I think the ideal policy would guide inflation to 2%, but asymptote, a word that you love, Tom, asymptote to 2%. So you want this gentle reduction in inflation right down to 2%. You don't want to be bouncing above and below 2%. I think you want this nice glide path into 2%. So hopefully that's what we'll get here. And this report today is very encouraging.
And so, Jim, there are folks out there in academia, in practice, in the marketplace that think this Federal Reserve is already behind the curve, that they should have already been cutting now. How do you think about that?
So I've argued that earlier this year. We did get tremendous reduction in core PC inflation in the second half of 2023. It was 4.8% last summer on a 12-month basis. It came all the way down to 2.8%. So in this world, in this game, 200 basis points of inflation reduction over 6 months or so is fantastically large. So you should be taking that into account. You should be reducing the policy rate, but the committee just couldn't find the right moment to do that because all the inflation reports up to now were mixed or even negative. So unfortunately, didn't find the right moment to do that. But this idea that the policy rate is a little too high for where the economy is today, I think makes a lot of sense. So I've advocated for like a technical adjustment. You know, you want to get this idea across that because inflation isn't near 5% anymore, core inflation, it's now under 3%. We can afford to reduce the policy rate, still be restrictive, and get this glide path into 2%, the 2% target.
I'd love to get your opinion on another topic that investors are thinking about, which is this is an election year. And what does that mean for the Federal Reserve as to timing? I mean, a lot of folks are saying you don't want to be too close to the election, so maybe September might not be the right time.
I think first of all, I don't think anybody ever won an election based on whether the Fed did something at the September meeting. So I don't think it matters for actual election outcomes. I don't think the median voter is voting on that. They're voting on much broader issues. So I think that the committee feels emboldened to do whatever it thinks is right at that meeting or any of the other meetings in the lead up to the election. And they have moved in the past during the election cycle, and I think they can do that if they wish this time.
When the Fed does begin to cut rates, how should we think about the next 3, 6, 9 meetings after that? How will they proceed in what may be a prolonged rate reduction move? How will that proceed, do you think?
I think it'd be slow. I think that, at least as of today, you would think that the inflation rate would come down slowly toward 2%, but it would depend on the data and what else is going on, as it always does.
I look at the Fed, and I'm going to be honest, Jim Bullard, you have prodigious economic chops. There's a few other people out there as well. But the fact is, on this program, we've had more than a few guests take a shot at a central bank that seems to be in love with non-economists. Do we need a representation at the governor's level and at the senior levels of the Fed that includes prodigious PhD macroeconomics, or can we go with a more generalist approach?
I think it's great to have a mix of voices and a mix of backgrounds on the committee. I think it really helps. You get too many people like me, and you get in too much in the weeds about analysis. But if you don't have enough of that, then right. You can't do a good job either. And so a good mix is the right way to go. I've learned a lot from my colleagues that have markets right. experience, and now there's a couple of new people coming on that have a lot of markets
Jim
experience.
Bullard, with this we continue. He's at Purdue, of course, at Krannert and White, the Mitch Daniels combine out there of their great graduate and undergraduate programs. Here's the history, and you're never going to admit it, but there was a rogue dot. There was dots.
DOTS go.
And you don't know which dot is. You don't know which dot Janet Yellen was, but you knew which dot Bullard was because there was a rogue dot. Have the dots lost their meaning as you protested with your rogue dot? It could barely fit on a Bloomberg screen. Tom Secunda is over in Bloomberg LP aging because you ruined the dot screen.
That's well, it was a different era. We were talking about regimes earlier. It was definitely a situation where interest rates were low around the world. You had negative nominal rates around the world, and I just thought, why don't we just admit that we're in this low nominal interest rate, low inflation regime, and project based on that, and not try to project that we're going to switch.
Have the dots lost their sell-by date? I mean, is there any efficacy to the dots now?
I think there could be great reforms on the dot plot, but the committee has just not wanted to make those reforms. One thing that's very strange about the dots is that the horizon shortens up as you go through the year. So now you've got a dot plot that really isn't comparable to the previous dot plots because now you've only got 6 months left in the year, whereas when you started you had a whole year out in the future. So
I don't know this stuff. I think it's all just idiocy, and I don't focus on the dots.
It's a great function.
Save
dots
me,
go.
Paul, save me.
I'm trying to explain to my offspring, Jim, that about this is a more normalized interest rate environment. This is where most of the time this society, this economy lives, and they're trying to figure out how to borrow for cars and houses and things like that. Is this, in fact, where we're going to be for some time, do you think, this kind of general interest rate?
I do think we're in this higher interest rate regime, and I do think that it's better on the whole. If you think about the second half of the 90s, which was really the best period for the U.S. economy in the post-war era, that had interest rates like we have today, broadly speaking, and the economy can grow very rapidly. We had a great run at that time, And I do think you probably get a little bit better allocation of capital because it's more of a decision about is my project really worth it or not, and you don't get this kind of experimenting around with kind of projects that probably have low payoff.
Your West Lafayette, Indiana,
yes,
has a 3.0% unemployment rate. They're fully employed at Harry's Chocolate Shop. I mean, there's just no question about it. What does urban America, I mean, you and I have talked about this in your offices in St. Louis years ago. What is urban America missing about the vibrancy of the Midwest of this nation?
I think the Midwest is extremely powerful, very populous. It might not all be in one place like it is here in New York City, but really a lot of people, a lot of great manufacturing, a lot of great businesses spread out across the Midwest, and it's a great place to live. And that because you're more spread out, you have better housing markets and better options.
Is there a labor arbitrage still going on right now where, I'm sorry, we're gonna take the Biden investment program and that's where we're gonna find the jobs? Because the labor total cost all in is better.
There's a lot happening in Indiana. One thing that's happening is this I-65 corridor between Lafayette and Indianapolis. If you drive up and down that, you'll see lots and lots of businesses locating there. And we just had a deal with a South Korean chip maker that's going to move to West Lafayette to Purdue.
In studio with us, the former president of the St. Louis Federal Reserve System, James Bullard. He of Indiana University. He of a profoundly important paper, I'm guessing 2016, on the regimes that we face within our monetary policy. Paul, I can report to you at his Purdue, at Harry's Chocolate Shop, right at the top of the menu, domestic cans, they have Budweiser.
I know.
Very important.
Well, Tom, I found another place we're going to have to go to. This could be a busy time for us there. Linwood Tavern Bar and Grill.
Yeah, I've heard. Rachel's mentioned this to me.
I mean, exactly.
3 days
the
a week.
Wabash River's right there.
You study, when you do all-nighters in mathematics,
Linwood
that's where
Tavern
you do
Bar. That's my kind of place.
Jim Bullard with us. Jim, I got to go to monetary policy here and the measurement of the inflation-adjusted yield. As you mentioned, we had negative rates. Nominally, it was completely wacko when you were, doing the St. Louis Fed. We're now back to a 2%, 2%-ish 10-year real yield. Does that impinge on investment in America?
I think it does, and like we were saying earlier, I think it makes people think more carefully about their projects. What is really going to pay off, and you get probably rid of some of the malinvestment or the misinvestment that might otherwise occur with very cheap money available.
Hey, Jim, to what extent does the Fed think about the consumer here? Because you think about the American consumer, we probably have at least two sets of consumers out there. The folks that are maybe, do have some assets, whether it's stocks, bonds, real estate, doing well, maybe even benefiting from a higher interest rate environment. Everybody else who may not have those types of assets or economic support, they're really feeling the impact of inflation. How does the Fed think about that?
Yeah, I think inflation is very pernicious and punishes the lower end of the income distribution very heavily, and you're certainly seeing that and hearing that when you talk to people in surveys. They do not like the inflation at all. They do not like the fact that the price level is up some 19% since 2021, and they're very upset about that.
One final question, blistering question. SK Hynix, they're going to invest in Purdue Research Park.
Yes.
The number one thing in the zeitgeist is America doesn't have the employees to be labor in those factories. Are you confident we can develop highly motivated, skilled labor as we perceive in Asia?
No, I think we'll have no trouble pulling in the right workforce for the South Korean company, and that'll be a major chip manufacturing facility. We've tried to reshore a lot of our chip making, as you know, across the country, so this is part of that effort.
Jim Bullard, two future governors of the Federal Reserve System, Constance Hunter and Julia Coronado, are here. On your way out, say hello. You're hugely qualified. Jim Bullard, thank you so much. Greatly appreciate it with the St. Louis Fed. We had a huge response the last time he was on. Dr. Mark Zandi joins us from Moody's. He was definitive in the great financial crisis for perspective and optimism on the American economy. Dr. Zandi, these results, which are the undershoot a select few talked about, do they finally show to a Fed a disinflationary America?
I hope so, Tom. I mean, it feels like all the trend lines are moving in the right direction. Inflation's coming in. The only thing that's keeping overall inflation from the Fed's 2% target is the cost of housing, the implicit cost of home ownership. If I were king for the day, I wouldn't be looking at that. I'd be looking at inflation X OER, owner's equivalent rent, and we're there. So, hopefully the Fed takes solace in this, and they're not going to move today, but hopefully they move in the next few months. We need interest rates to come down.
Mark, I'm just looking at Bloomberg red headline across the terminal. Fed swaps fully price in quarter-point rate cut in November. Does that make sense to you?
Yeah. It feels like a preponderance. Investors probably feel like September is when they'll start to move, and by November, I think that very high probability that they'll have cut rates by that point in time. I mean, everything is where they want it to be, right? I mean, the economy's at full employment, 4% unemployment rate. The labor market has cooled off sufficiently, so wage growth has come in, which is consistent with getting inflation back in the bottle. You got inflation coming back in a very graceful way. Financial conditions are, I think they're right where they want them. The stock market is up, credit spreads are in, but the dollar is strong. You add it all up, it feels like they're there. They should declare victory and move on. So yeah, by November, I would be surprised if they haven't cut rates.
Out on YouTube, the live chat, a really smart observation. Thank you so much for this. I am glad I was able to roll over a bunch of CDs. And Paul, you've talked about this. If you get a Zandi disinflation in place, when does it finally crack that 5.X% money market
That's
fund?
why this Sweeney offspring 1B, she was very smart getting into her CD at 5%. I'm very proud of her for that. Mark, are you in the camp that says maybe even that this Fed is behind the curve, that they should be cutting already?
Yeah, I would have argued that they should be cutting rates. I think they have achieved their objectives, properly measured, and 5.5% federal funds rate target where we are today is just not necessary. I mean, there's a lot of reasonable debate as to, what the equilibrium rate is. The rate that's neither restraining or supporting growth. It's higher than it has been historically, but it's not 5.5%. So why such high interest rates when you've achieved what you set out to do? So in the economy, I think the economy is going to soft land. That's the most likely scenario, but the risks of it going off the rails are not inconsequential the longer you keep rates unusually high. So yeah, I would have argued that they should be cutting rates already.
Mark Zandi with us with Moody's. We will continue with them. We're commercial free this entire hour for you. Thank you so much to Commonwealth, to CohnReznick, to Interactive Brokers for their support of our discussion of economics. If you're just joining us worldwide on YouTube across this nation, a stunning report. It is what a few wrote about. Good morning, Goldman Sachs and Jan Hatzius, who really parsed this. I thought, well, what if it comes in with an undertone? Headline CPI 3.4%, came in 3.3%. Futures up 42. The Sweeney yield here, the 2-year yield in 14 basis points, 4.70%. Paul?
Hey, Mark, what do you think the Federal Reserve is really keying on here, and what kind of message do you think they want to get across today?
Well, I think with this report, they have a strong case to make that interest rates are coming. I think they will still make the argument that they want to see more inflation, good inflation numbers, things that are inflation numbers that are very consistent with their 2% target. But with today's numbers like today, which augurs well for the consumer expenditure deflator, which we're going to get here in a couple of weeks, which is what their target is based on. I think they want to signal that if another month, 2 or 3 of good inflation statistics, they'll cut. The numbers like this really makes the case very easily for a rate cut.
Okay, Mark, I'm looking at inflation back pre-pandemic, and we had immense stability. Core CPI, we were at 2%, 2.2%. The two standard deviation band, I don't want to get too mathy here, was extremely narrow, extremely predictable. We had an upset of disinflation, deflation down to 1.x% with the pandemic, and then boom, the stimulus up over 6% core CPI. I see almost, Dr. Zandi, an inertial force of disinflation now, almost with what I'm going to call convexity or acceleration in the form of disinflation. Explain to our audience why this central bank that you think should cut this afternoon, that's a joke, I'm putting words in Dr. Zandi's mouth, but Mark Zandi, why are they such a slave to an ex post strategy? What are they afraid of?
Losing credibility, Tom. I think they've got a target, the 2% on the consumer expenditure deflator. They feel like if they don't hit that target, they'll lose credibility. And credibility really is important. That's key to keeping inflation expectations down. People have to believe, investors have to believe the Fed is going to do, what it says it's going to do. So I think that's the motivation here. Now, having said that, I do think once they hit the 2% target and they do start cutting and they kind of rethink their framework for monetary policy going forward, that they should come up with a better mousetrap, that the 2% target on consumer expenditure deflator is probably not the target they want or the way they want people to think about it. So once they've gotten there, they've established credibility, then they really need to think about their framework and how they want to do this going forward. 2% is not the right number, and the PCE is not the right deflator.
Zandi, Paul, this is so important. You're going to see a tweet someday. Zandi, National Bureau of Economic Research, NBER. It's going to be a paper by Mark Zandi, the Fed, and the Better Mousetrap. That's where we're heading.
All right.
I like that title. Yeah, exactly. I like that.
Hey, Mark, what do you think about, when you see an inflation print like today, what do you think about the U.S. consumer? Because the U.S. consumer, if you go out there and ask the consumer out on the street in South Philadelphia or, Peoria, they're going to say, boy, I'm paying a lot for a lot of the key things I have in my cart every day. How do you think about the consumer these days?
Well, you're right. They're still feeling the financial pain from the surge in inflation that Tom mentioned back 3 years ago, particularly for staples, for food, for rent, for gasoline. But I do think the sting of that those higher inflation numbers are starting to fade and to continue to fade going forward, because look at food prices today. They barely rose on the month. On year over year, food at home is up 1%. Rents have been flat for a couple of years. Market rents have been flat for a couple of years. Gasoline prices are back down to $3.50 per gallon of regular unleaded.
Mark,
and wages are growing more strongly. So I think they should, there's no game-changing event here in terms of how people think about things. But I think with each passing month, they should feel better.
Dr. Zandi, got time for one more question. I want to go to University of Pennsylvania and your inbred optimism on the American economy. Are we underestimating American growth given new productivity, new technology? Joe Weisenthal would say AI, EIO. Mark Zandi, do we underestimate American growth?
Very possible, Tom. I think a prudent planner would say, okay, we're going to grow 2% real GDP. I think that we should count on that. That should be baked into our budget forecasts and planning as business people and as government. But I do think there are risks on both sides of that. But I think there is a good argument to be made that the economy is going to perform better here than people anticipate. We did that last year in 2023. Much better than folks thought. A lot of folks thought recession. We got even not only not a recession, but a very strong economy because of those supply side benefits you talked about. And that could continue.
The heritage of our guests are important. Fantastic. I can't say enough, Paul, for how Mark Zandi was a nearly lone optimistic vote. Think spring of 2008. He was saying, we will clear the markets. Yep. We will do fine. On this. Dr. Zandi, thank you so much, always with Moody's as well. This is a joy. This is something Paul's demanded that we get from MacroPolicy Perspectives. Constance Hunter in here, with Julia Coronado, and to have them, Paul, on this day is just, I just think killer. Julia, does this shift Powell's discussion of the character of our disinflation, this stunning report?
I think it's an important report. I think Chair Powell is likely to express some optimism that progress has resumed after a disappointing first quarter and that the plan to lower rates is on track. We think that they'll come out with a 2-cut baseline. This report sort of solidifies that. We think that Chair Powell sort of has that control over the median and the message, and that he can sort of credibly express optimism, say that we saw some broad-based progress in today's report after a decent April. So if we get a few more prints like that, then they can begin a process. The Fed is now having to deal with the decision of, do we start early so that we can go slow, or do we wait till weakness arrives, which is the track record of central banks, right? Wait till weakness arrives and then cut quickly. This is a new approach, or a relatively untested approach. She's laughing at me because
she knows I'm going to go mental. Yeah. Paul, save me. Put the surveillance cork in my mouth. Paul, save me.
Constance, there's a lot of folks out there that says this Fed is already behind the curve, that they should be cutting already. Do you guys, how do you think about that?
I think that is a valid perspective. But of course, there's people who are saying that there's going to be no landing, that the Fed isn't going to cut at all this year. So I think I understand the perspective of the Fed of deciding to wait, given the prints that we had in the beginning of the year, and given the fact that we're seeing anomalies in the CPI data that we didn't see prior to the pandemic. And so I think from their perspective, caution is the better part of valor. On the other hand, as Julia said, historically, they are late. And so I think that they do run that risk. Fortunately, the jobs print last week was stronger than expected. But our big concern if they're late is that labor market starts to weaken. And once you see that, it's too late because it is at best a coincident indicator.
Right. And Julia, Joe Weisenthal from Bloomberg Odd Lots podcast just moments ago said, raising some concerns about the labor market here, that 4%, you got to pay attention to that kind of number. So how do you feel about the labor market?
Yeah, no, I think that the May employment report was truly mixed, right? The payroll number is strong, it was broad-based, but the household survey is showing rising slack. You have to take that message at face value. The fact that we have gone from a low of 3.4 to 4.0, it's still a low unemployment rate, still a healthy job market, but it is is more balanced than it was before. There are risks on both sides now. And as Constance said, if you keep restrictive policy in place for too long, then you're going to lose that resilience. So even actually Governor Waller said this earlier this year. He said, the low-hanging fruit of bringing down job openings, without a rise in unemployment is probably behind us. To really see a decline in labor demand from here, you're going to get that alongside a rise in unemployment.
We're going to come back. It's just a joy to have Constance Hunter and Julia Coronado with us. But Julia, I got one fundamental question. Are we more than ever, John Edwards in Louisiana, as you were studying in Texas, are we more than ever two Americas? And the idea of aggregate analysis at the Eccles building is just quaint.
I think there are always lots of Americas.
But is there more now? Is it more polarized now in terms of
politically?
Paycheck?
Absolutely, we're in a very polarized. Economically, no. I would say, Tom, actually, the good news is that we're less polarized economically, in a sense that the lower wage workers had the best labor market they've seen in generations this cycle, and it hasn't cracked yet. Really, the weakness we see in the labor market is at the top. It's the professional service sector jobs that are experiencing the weakness. So no, I would say actually we've seen a narrowing in wage inequality this cycle that we haven't seen in 30 years.
It's just a bang-up day here, folks. We have Jim Bullard with us, the former president of the St. Louis Fed, and here for a half hour, Julia Coronado with us and Constance Hunter of MacroPolicy Perspectives to get us towards the Fed meeting this afternoon. Most importantly, at 10 o'clock, Paul Sweeney will drive forward with Alex Steele. I mean, you got something to talk about after this inflation report.
We got again a very interesting inflation report. Something very important for the Fed to take into consideration here as we hear from the Fed. And you're going to have full coverage this afternoon, right, Tom? Starting.
Can I go odd?
Sure.
Mexican peso weakness.
Oh, I don't know where to go there.
Is just stunning.
Yep.
We have Julia Coronado in the room. You think we should go all Mexican peso on
Do
it?
that.
Yeah.
Well,
there it is.
That's political risk for you.
Yes,
Yeah.
exactly. And the bond market action we saw in France yesterday, on just a rumor, there's a lot of uncertainty.
What a joy to have us here for a half hour. Julia Coronado and Constance Hunter of MacroPolicy Perspectives. Constant, I love Neil Duddy. He doesn't mince words. May I quote, Paul?
Sure, let it rip.
It does not take a rocket scientist to figure out what needs to be done.
Yeah.
And he's like, let's go. Fed needs to get on with it. Constance, what are they waiting for? I mean, I get it, they're ex post. We all know this. Can we really hope for a new regime where they get on with it?
I mean, one thing that is going to hold them back is that shelter print. Now, that was isolated to New York rents, which went up and played an oversized part.
No. How much did 2 blocks in New Jersey play? Paul, step in here. Are you telling me national inflation was Paul Sweeney's housing fault?
I think it was Paul Sweeney's fault in particular, yeah, he's to blame. You should get all the hate mail. No, but seriously, they're going to need to see that shelter number come down a bit. But I don't disagree. Look, September has to be firmly on the table. The markets believe it's firmly on the table. And even a Fed that's a little bit behind should be able to move in September.
Joey, how do you think about the U.S. consumer here? Because we're getting inflation's coming down, but it's still at that high reset level, up 19% versus 2019. How's the U.S. consumer doing today?
Look, I'll reframe it this way. We should thank the U.S. consumer because one thing we keep hearing in earnings reports and in the Fed's beige book is that consumers are price sensitive again. Mm-hmm. When we look at things like goods prices, broad-based deflation, consumers want deals and they're getting them on cars, on furniture, and on apparel this month. So
on airfares.
Airfares plunged. So consumers are back to that norm that they had before the pandemic of, to part with my money, you're going to have to offer me value. And that is helping restore healthy inflation dynamics. So they might still be grumpy from what we've all been through. Mm-hmm. And we also, as Tom had alluded to, see a lot of polarization in those sentiment numbers. But the reality is that consumers have taken control back. That pricing power that companies enjoyed during the pandemic has evaporated, and now they need to deliver value. So some of those margins are going to get pressed.
We had a GDP number first quarter. Where are we? 1.3, 1.4%, whatever. Atlanta GDP balloons out 4%. They bring it back. Now we're running. What's the run rate? To both of you, do you guys argue about this? What's the run rate on real GDP? Are you that far apart, the two of you?
I don't think so. I think we're both at about 2.4, 2.5. I mean, you have to look at GDI when you look at this, and last quarter was really trade and inventories, right? And so the question is, how much are those inventories going to be rebuilt? That's a very tricky thing to forecast. And then obviously we have the strong dollar, which is hurting trade in some respects, but we also see tailwinds from the global economy that we haven't seen for 4 years that could slightly help our trade numbers.
I mean, it comes down to domestic final sales. Mm-hmm. What's 12 months for? I mean, Julia, you were at BNP Paribas years ago making headlines on this. What's domestic final sales look like 1 year out? Don't give me this gloom stuff.
No, it's not gloomy. I think we're both very constructive on a better productivity cycle, not just because of AI. AI hasn't even begun to enter the room yet. This is about a healthier labor market. It's entered the stock market room, but not necessarily the productivity numbers. We've had a strong investment cycle. We've had a good labor market, good matching of employers and employees. And we're not deleveraging. Last cycle was all about deleveraging and global fragility and financial fragilities. And we have strong balance sheets and a healthy, broad-based economy. So I think we are pretty constructive that we've got a better productivity trend. We've got immigration, at least for now. That's going to be a big policy differentiator in 2025. Right. But for now, the U.S. economy looks like it can run, above 2%. and not generate inflation.
Apple's up 9% since the gloom of the AI presentation.
Exactly. That's
209.
This is just the AI bump that everybody was looking for, and they got it
You
up another
told me
1%
not to
today.
buy. You told me not to buy.
I probably did. Too expensive, but here we go, up higher again.
Hey, Constance owns NVIDIA, so.
There you go. Very good. Very good for you.
For a while, actually.
Good for you.
Now I need to start trimming that position.
Just keep loading it up by the momentum. Constance, what would you like to hear from the Fed chairman today versus maybe what do you think we will hear from the Fed chairman?
Yeah, that's a great question. I mean, I'd like to hear him say that as long as inflation is making progress towards 2%, that it will be appropriate for them to take away some policy tightness. And let's remember, where is our star? Let's say it's higher. Let's say it's 3.5, right, instead of 2.5. Let's say it's there. They can start cutting and still be restrictive. And so I'd like that message of we can start cutting and policy will still be restrictive.
Okay, so economic historian from the University of Texas, is there any heritage that we do that besides a Greenspannian measured after the fact? I don't observe it. I mean, Richard Timberlake at Georgia or McTeer at Dallas Fed years ago, no.
Yeah.
There's no history of what Constance Hunter just said.
History of what you just noted is Greenspan, is the mid and late 90s, where they kind of ebbed and flowed the Fed funds rate. It went up, it went down, it went up, it went down, and without a recession. And it was about fine-tuning and keeping the expansion.
Does he have to address that today as Lagarde and Company
He might.
addressed it at ECB?
I certainly hope that the Bloomberg reporters in the room ask him that very question, because they need to have a strategy. That's the one they've been
Rich, take a memo. Coronado wants to tell McKee what to say.
Well, and you brought up McTeer, and he was the one arguing for the productivity revolution. He was the one arguing, saying we're going to be getting productivity, and we need to make sure that we don't raise rates into this stronger GDP, because if you recall, in the second half of the 90s, GDP started to gain momentum after those 3 rate cuts, while inflation fell.
The 90s, late 90s were very good to me.
They were
Tom.
good times.
I don't remember. I'm too young.
So, Julia, I'm trying to explain to my kids who are in the workforce now that this is a more normalized rate environment. The zero stuff we lived through before.
Yes.
Is that kind of where we are now?
Yeah.
Are we back to normal, I guess?
I hope so. I mean, I think we're in a positive real rate environment. It looks like the economy can handle that. So I agree our star is probably higher. That's where we wanted to end up, right? Mm-hmm. That's what the whole idea of the last strategy review at the Fed was about, engineering a somewhat higher run rate on inflation and gaining some policy space. And I think signs are that that's exactly where we're heading. That will give them better trade-offs. I know, I'm going to say this and people's heads are going to explode. We've got a better mix of fiscal and monetary policy now. Of course, 6% deficits are not sustainable forever, but what we have had is better state and local government, better fiscal participation. The Fed isn't carrying all the water for the economy.
You guys aren't allowed to travel together for safety, but have you guys talked about how you adjust your Fed calls seriously to the end of the year? Did you make a switch this morning? Will you publish for MacroPolicy Perspectives some switch this morning?
I think what we've been flagging for our clients is that the outcome of today's meeting and the tone and the tenor is going to depend on this morning's data. It is an important data point, and if we get what we were below consensus on inflation, it came in at our actually even a little bit below our forecast, but that would lean towards a more positive, constructive message that we're going to start in September. So I think that's where we're at. The data has ratified that orientation, and now it's up to Chair Powell to deliver the message.
And Paul, Ian Lingen is a third of a way to a stunning call in the 10-year yield. Yep. 4.28%. Yep. I'm not saying it's going to drive lower, but that's what BMO Capital Markets is saying.
Yep, exactly. So where's Constance? Where are you guys thinking about GDP this year and next year? How's this economy going to be growing?
Yeah, so we had originally been thinking we would have a soft patch this year because higher rates would begin to take a bite out of growth. And now we're thinking that if the Fed can act and that in time, that may be able to be avoided. And part of the reason that's going to be avoided is this productivity story that Julia was talking about earlier, right? And all of the aspects of that are playing out in the economy. So we're looking for a little softer than last year, and then a little bit of a pickup probably in the second half of 2025 as lower rates continue and feed into growth story.
Way too optimistic. Constance Hunter, Julia Coronado, MacroPolicy Perspectives. Can we do this again? This has been
Yes.
Yeah,
Thank you.
absolutely.
Thank you so much. Right now, we've really been anticipating this. If you get off a plane at Heathrow and you take the road in the green, they have these taxi cabs, Paul, that drive like a Bentley. They're like electric taxi cabs that are spectacular. And if you drive into Jonathan Maxwell's London, it's immediately evident that it's different than here. And then you take that over to the recent elections in Europe, and you've got a green Europe, a green United Kingdom compared to the United States. And this is front and center now with all the politics of France, Macron, frankly, of Germany as well. Jonathan Maxwell, CEO at Sustainable Development Capital, a heritage with HSBC Infrastructure. Jonathan, thrilled to have you on the show. The protest against green in the recent elections, is that about green or is that about the cost of green to citizens?
It's mostly about economics. I mean, there have been there's a statement by the Italian Prime Minister pushing back, for example, on one of Italy's greatest industries, the motor industry, and the European proposals to phase out petrol diesel cars by 2035, saying that was an ideological mistake or an ideologically led mistake, right? But yes, I think that the economics is one of the very big factors that's going on here. Look, 2-3 years ago in Europe, you'd be accused of greenwash. That is, you're trying to put yourself out as green as a government or a company, and you're not as green as you could or should be. Then it got into kind of green hush. People got sued overstating.
Yeah, interesting.
Now we're in this kind of what the European Council on Foreign Relations calls green lash. You are backlash against the economics.
Jonathan,
it doesn't be that way.
You're encyclopedic on this. And I'm fascinated if green in Europe comes towards what I'm going to call the anti-climate change of America, or does America come towards the green of Europe? Which is it?
Look, there are three big things going on here. The biggest one is about economics. And I'll come back to that because I think it's just completely misunderstood how the economics of the energy system can and should work and does work today. But there are a couple of other bits that are going on in Europe. We've got a huge problem with energy security and resilience in Europe. There's a very big difference from America and Europe, which is that you make energy. In fact, you're a net exporter. You're the world's largest oil and gas producer and exporter going forward. Europe doesn't. It imports energy, right? It depends by and large on other countries. In fact, now after the Russia-Ukraine crisis cut off gas to most of Europe, actually Europe's now dependent on the United States as much as other regions like Qatar and so on. So there's a big difference. You export, we import. We being Europe, right? But resilience and energy security is now a massive feature. The second massive feature, obviously, is environment and carbon. And yes, there have been some really quite progressive policies in Europe. But you've got the Inflation Reduction Act. It's dollar for dollar. It's about the same amount. If you look at the amount of money that's being put in to, so to speak, the green or climate economy in America versus Europe, it's about the same. It's about the same. We had about a $750 billion post-COVID stimulus package. Biggest part of it, which is now the controversial bit, is the Green Deal. It's about the same as the Inflation Reduction Act. But here's the big one, and this is why I think it's so misunderstood. If people are pushing back in Europe on the energy or clean energy sector for cost, it just misunderstands the biggest problem with the energy sector. Most of it's wasted. In America, about 70% of all the primary energy, that is all the original natural resource, is lost before it gets to the point of use through conversion, generation, and distribution and transmission. It's about the same in Europe. So what actually the European real policy is on energy is actually very, very interesting and possibly more progressive than America at this stage. And it basically says energy efficiency first. What happens if you use less energy to do the same job or more? You become productive, more competitive. So actually, now there are some strange, maybe over-egged policies where, doing things like maybe people got a bit too excited about technologies like hydrogen from time to time. Batteries don't necessarily help and cost more, but there's an awful lot we can do that costs less.
Right. And Jonathan, General Atlantic Fund, I mean, these are financial players. They just bought a stake in your company. I mean, that tells me that, I don't know, some smart money is still pursuing these types of policies. Talk to us about that transaction.
So, I mean, our firm, our company, Sustainable Development Capital, fundamentally looks at the world and says, what's the most resource efficient way of doing business? Why do we care about being resource efficient? Because you can use less and do the same or more. That's more competitive, more productive, more profitable.
Yeah, but in the time, I want to interrupt here because I think, Jonathan, this is really, really important. In the time that we've got left, is it simple to say that with these set of elections, there's been a massive protest against green? Is that correct or not?
I think that there's been a protest. There were 73 seats out of 705 that were green. It's now 53 seats. The bigger story is the fact that the real opportunity for Europe and the real problem is how do you manage cost and reliability and carbon and energy? The real solution to that is be more productive, more efficient, more competitive. And it's efficiency first. That's the European policy. That's the business plan. And that's what General Atlantic have backed in us, because that's everything that we do. When we make investments in the market, we're looking for project companies, opportunities that are more energy efficient because you can deliver the same or better outcome economically using less energy. That's the biggest bang for the buck from a carbon emission reduction perspective.
Jonathan,
and that's what General Atlantic are backing.
I have to go. Jonathan, thank you so much. Jonathan Maxwell with us with Sustainable Development Capital. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.